am Balint, partner at EY with a focus on SAP. Welcome to the SAP Weekly Brief. The weeks since our last topical episode have been the most consequential of 2026 so far. SAP secured a strategic regulatory win that almost nobody is talking about. European Commission is closing in on a settlement that could fundamentally change SAP's pricing model. Oracle dropped a capital expenditure announcement that shook the entire enterprise software sector. Goldman Sachs cut its margin forecast. The share price hit a fresh 52-week low. And in the middle of all this, SAP continued executing the post-Sapphire roadmap with quiet precision. This is the episode where we connect the dots. 5 major topics, 1 strategic picture, and what every CXO needs to understand before the July 23rd Q2 results. This is the independent commentary, not investment advice. All sources are linked in the show notes. Let's get into it. Section 1, the sovereignty win that almost nobody is discussing. Let's start with the announcement of June the 9th. Germany's Federal Office for Information Security, the BSI, granted SAP authorization to process VS-NfD classified data on SAP's cloud infrastructure. VS-NfD is Germany's second highest security classification. The organization applies to SAP's own data centers in Walldorf and St. Leon, staffed exclusively by security-cleared personnel. Here is why this is bigger than the financial press treated it. SAP is now the only provider in Germany whose platform can support both SAP applications and customer-specific applications in a high-performance VS-NfD compliant cloud environment. That last part, customer-specific applications, is the strategic move. Until now, defense and public sector workloads either run on premises, on Delos Cloud, or comprised on US hyperscaler dependencies. Now there is a German-owned BSI-authorized sovereign cloud that can host the entire regulatory estate. The platform sits on 3 independent availability zones in physical separated data centers with certifications including the IT Grundschutz and German Federal Data Center Requirement Catalog, etc., etc. SAP also separately secured authorizations for Pentagon use in the US states. SAP now holds dual defense cloud clearances on both sides of the Atlantic. For CXOs in regulated industries, defense, public sector, financial services, healthcare, energy, critical infrastructure, this needs to be on your architectural roadmap conversations in the next days. The EU Data Act is in force. Sovereign Cloud is no longer a niche concern, it is the new baseline, and SAP has positioned itself as the only provider that can run your entire regulatory estate inside that baseline. Section 2, the EU antitrust endgame and why this changes negotiating leverage. The European Commission antitrust investigation into SAP's maintenance and support pricing practices is in its final stages. It is focusing, based on September 25 filings, on 4 specific practices in the on-premise ERP aftermarket, and I'll tell you why this is important. The Commission alleges SAP requires customers to buy the same level of maintenance for all on-premise ERP instances at the same pricing. It alleges SAP blocks customers from canceling maintenance for unused licenses. It alleges SAP systematically extends SAP license terms to prevent termination. And it alleges SAP charges reinstatement and back maintenance fees that effectively penalize customers for trying any alternative. In November 25, SAP submitted formal concession to settle. The Commission conducted a market test of those proposals. The remedies SAP has offered include wider access to single metric contracts, the ability to place unused licenses in a separate shelfware partition, and end maintenance for that part, clearer contractual provisions on initial license terms, and abolishing reinstatement fees plus reducing back maintenance fees. A negotiated settlement is now widely expected. The implications for every CXO running SAP are concrete. First, in any current maintenance negotiation, you now have additional leverage. SAP knows the remedies are coming. Use it. Second, customers who have unused licenses sitting on the shelf will soon be able to formally decommission them. Document those licenses now. Third, this case will likely influence cloud contract terms even though the investigation technically only covers on-premises, because the underlying principles of customer flexibility apply equally on subscription models. The potential fine, if SAP refused to settle is up to 10% of annual global revenue, over 3.5 billion euros. SAP is not refusing. The company has stated does not anticipate material financial impact. But the impact is on customer negotiation leverage. And this is real. Section 3, the Oracle CAPEX shock and why it hit SAP. On June 10th, Oracle reported earnings. The numbers were strong, the reaction was brutal. Oracle disclosed capital expenditure guidance of $90 to $95 billion for fiscal 27, substantially above the $68 billion analysts expected. The market immediately repriced the entire enterprise software sector. The logic transmitted to SAP on a single day. If Oracle needs nearly $100 billion in AI infrastructure capital expenditure to stay competitive in the agentic AI race, what does SAP need to spend? And what happens to SAP's margin as it competes in the same hardware-intensive layer? Goldman Sachs responded within days. The bank trimmed its second half 26 gross margin forecast of SAP. It pulled full-year operating profit growth. It kept the buy rating. The message was clear. The AI infrastructure capital burden is now a real margin question for SAP, not a theoretical one. The share price reaction was severe, over 5% fall down on June 11. They continued under pressure. They touched a fresh 52-week low on June 19. The stock is now down approximately 34% year to date. The disconnect between fundamentals and price has reached its widest gap of the year. What is the honest read of all this? Oracle's announcement does not change SAP's underlying business. SAP is not Oracle. SAP is not building hyperscaler infrastructure. SAP is operating an application platform business on top of partner infrastructure where possible, and its own sovereign infrastructure where regulatory requirements demand it. The capital intensity question is real, but it is a different question than the one Oracle is answering. But narratives matter, and the current market narrative groups SAP with Oracle's haste for ServiceNow and Workday as a single category of enterprise software stock under pressure from AI capital intensity. Until SAP demonstrates with concrete numbers that its capital expenditure trajectory is fundamentally different from Oracle's, the category sell-off will continue to weigh on the share price. July 23rd is the next chance to break the narrative. Section 4, the execution quietly continuing. While the financial press is focused on share price drama, SAP has continued executing the post-Sapphire roadmap with remarkable consistency. Let me cover that. What actually happened in June. Joule Studio 2.0 began first customer rollout in June as Philipp Herzig promised at Sapphire. The SAP AI Agent Hub is now on track with more than 680 agent submissions already in the partner pipeline. Autonomous HCM components are reaching general availability through June and Q3. The customer reference machine is real. Ericsson deployed Joule to 85,000 employees. Madrid City Council went live on its tax management modernization. Martur Fompec International deployed Joule plus embodied AI robotics for manufacturing throughput. Victrola reported a 94% reduction in P&L reporting from time SAP Cloud ERP migration, published June 8. These are not press release wins. These are production deployments with measurable outcomes. SAP placed a 3.5 billion euro Eurobond on May 28th, earmarked for AI and cloud expansion. This is the capital that funds the AI infrastructure build-out, and it was placed before Oracle's CAPEX shock. SAP did not need to surprise the market with new debt. The capital is already raised. The June Joule release notes are extensive. The platform added project assistant capabilities, business partner entity support, backorder processing, custom sort sequences, supplier invoice integration, and dozens of other refinements. The development velocity is now slowing, and the Anthropic Cloud embedded deepened. Cloud is now actively reasoning inside SAP's AI portfolio and customer-facing scenarios. Mistral on SAP Business AI platform is generally available. Cohere North follows in June. The model-agnostic architecture is operational, not theoretical. The execution gap between what SAP announced at Sapphire and what is shipping now is narrower than the share price suggests. That is the most impact fact for the entire picture. Section 5, what the picture adds up to. Let me connect the 5 threads. SAP secured a structural sovereignty position that no European competitor can match. SAP is closing an antitrust settlement that gives every customer more negotiation flexibility. SAP is being mispriced because Oracle scared the entire category. SAP is executing the autonomous enterprise roadmap on schedule. SAP has 3.5 billion euros in fresh capital to fund the next phase. The honest read is this: the fundamental position is stronger than the share price. The execution is on track. The sovereign cloud play is a genuine differentiator in a deglobalizing regulatory environment. The EU settlement removes a long-standing customer friction. The capital is raised, customer references are real. What is generally unresolved? The capital expenditure intensity question, the API policy that I have flagged since episode 22, the Joule adoption metrics that need to scale beyond the 3%, the Middle Eastern customer that Goldman flagged as ramping down, the Q2 numbers themselves. But none of these change the structural position, they change the timing of when the market recognizes the structural position. My assessment from the UI perspective, 3 things I would tell CXOs this week. First, stop watching the SAP share price as a signal of strategic health. The price is reflecting category sentiment, Federal Reserve rate expectations, Oracle's CAPEX announcements, short-term margin concerns. None of those reflect the underlying competitive position. Read the architecture, not the ticker. Second, act on the EU antitrust settlement before your competitors do. In any maintenance or licensing negotiation happening between now and Q4, raise the 4 remedy areas explicitly. Demand shelfware partitioning, demand single metric contract access, demand clear initial term provisions, demand the elimination of reinstated penalties. These are coming regardless. Customers who incorporate these into contracts now will have flexibility, their peers will not. Third, take the sovereign cloud question seriously, even if you're not in a regulated industry. The directions of European regulations is unambiguous. Data sovereignty, AI sovereignty, and operational sovereignty are becoming baseline expectations for every European enterprise. The companies that build architectural optionality now will have it when they need it. The companies that defer the question will discover the architectural choices they have been made for them. Closing remarks. June 26 will be remembered as the month when the gap between SAP's strategic execution and the market's perception reaches its widest point of the year. Sovereignty secured, antitrust closing, execution shipping, capital raised, and the stock at a fresh lows. The company that reads this moment correctly will compound advantage. The companies that wait for the share price to confirm that the architecture already shows will be late. Thank you for your time, stay focused, and see you next week.